Most people invest with just one goal in mind: build up a lump sum of money and retire at 65 years old, and slowly sell off their asset until there is nothing left. But what if I tell you that you don't have to touch your principal at all? What if you built an asset that pays you thousands of dollars a month in dividends to live on, and then pass it down to your kids, grandkids to set up the generational wealth? And that's the exact power of dividend growth investing. To see if SCHD is the right vehicle to build that kind of cash flow engine, I spent hours analyzing its index rule, historical payout growth, and balance sheet criteria. And in this video, I'm breaking down why this fund stands out from a typical index funds, revealing the top 10 holdings and showing my Canadian viewers how to structure this inside your account so taxes and exchange fees don't ruin your compounding. Before we start this video, a little bit about myself. I studied accounting and now I am working as an accountant. Right now I'm working towards my CPA designation. I have been investing into the stock market since 2019 and I've been pretty consistent after that. And my only goal from this channel is to make investing simplified. The lessons that I should have learned early in the career to have good returns. I'm just sharing what I have learned in the past years. And remember, this is not a financial advice. I'm not a financial advisor, I'm an accountant. So let's get into the video. So reason number one comes down to finding the sweet spot between current payout and long-term price growth. So there is a huge trap for new dividend investor is yield chasing. So you see a fund paying an 8% or 10% yield today, and there are so many of those funds. But when you look at the 10-year price chart, the share price has been slowly bleeding out and it's slowly decreasing. So basically you are not actually making money. You are just getting paid back with your own decaying or own depreciated capital. But SCHD, it approaches this differently. And if you look historically, SCHD yields is between 3.3% to 3.6%, which is roughly the double and triple yield of S&P 500. But here's what my research is highlighted. It's not just the starting yield, it's the dividend growth rate. And over the last decade, SCHD annualized dividend growth rate has averaged around 10%. That means you aren't forced to choose between passive income today or capital growth tomorrow. The index structure delivers a mix of both. And just a disclaimer, SCHD is not really old like S&P 500 or NASDAQ 100. I think it was launched in 2011. So we're just looking at the past data that we have, and we can project what can happen in the future and how it performed since the day it launched. So this is how I researched this ETF. Now let's move to reason number two. And this is, I think, where most traders skip the details. Is the actual algorithm behind how stocks get selected. So SCHD doesn't just randomly pick the high-paying companies. It tracks the Dow Jones US Dividend 100 Index. And when you read through the official index or documentation, the screening process is pretty strict. The rule is a company must have paid dividend for at least 10 consecutive years just to qualify. So that filters out volatile growth stocks throwing out temporary yield. And second is liquidity check. So there is a minimum float adjusted market cap of $500 million. The third is quality filter. The remaining stocks are ranked based on 4 specific financial metrics. First is cash flow to total debt, checking if they can pay the bills. Second is ROE, return on equity, that measure profitability. Third is indicated dividend yield. And last one is 5-year dividend growth rate. And to keep it diversified, no single stock can make up to more than 4% of the fund, and no single sector can exceed 25%. So this is the best thing I like about SCHD. Especially right now in July 2026, a lot of people are talking about potential crash in next 2 months, 2 years, maybe 3 years, 4 years. Many investors, to keep themselves safe, are investing in SCHD. But it's not like you have to choose between one, S&P 500 SCHD or NASDAQ 100. You always have a choice. You can diversify your portfolio. You can put some money in SCHD and some in S&P 500. But the best thing about SCHD is that it gives good dividend. For sure, it has a nice dividend. But if you look at the CAGR for the last 10 years, the growth, it's almost 10%, which is very rare for the dividend paying ETF. So that's the thing I like about SCHD. Now, the reason number 3 is the fee structure. A lot of specialized dividend funds or covered call ETFs, they charge about 0.50 to 0.85% in management fees. SCHD expense ratio is very low, 0.06% only. So that's only $6 a year for every $10,000 investing. and letting you almost 100% of your money stays inside your compounding machine. Now, reason number 4 is value positioning. Because SCHD focus on healthcare, consumer staples, energy, and it doesn't always move at the exact same pace as mega cap tech. And when tech rallies hard, value funds can trade sideways or they can even dip. But as a cash flow investor, flat or dipping prices on a quality fund are a gift. Your reinvested dividend automatically buy more shares at a discount, boosting your payout on a next quarterly check. Now for my Canadian people, if you're watching this from Canada, there is a catch that you need to know before hitting a buy on SCHD. Because SCHD in US listed ETF trading in USD, where you place it inside your account structure dramatically impacts your actual take-home income. Let's look at Canada's 3 primary accounts. First is RRSP. I think it's the best choice, 0% foreign withholding tax. Second is TFSA. So there's a tax trap, 15% of foreign withholding tax. The reason RRSP is the sweet spot, because under the Canada-US tax treaty, the IRS recognized the RRSP as the pension account. And when ETF like SCHD pays dividend into your RRSP, 0% foreign withholding tax is deducted. So you receive 100% of your payout tax-free until retirement. The TFSA, the 15%, there is a trap. So the US government does not recognize TFSA as the pension plan under the treaty. The IRS automatically deducts 15% of non-resident withholding tax of every dividend check before it even hits your account. So on a 3.5% yield, you lose roughly 0.5% of yield, and you cannot claim it back. If it comes to non-registered taxable account, you still pay 15% of the tax, but in a tax season, the CRA lets you claim the foreign tax credit to offset the Canadian's taxes, so you are not double taxed. Except that withholding tax, there is also one thing, currency conversion fees. So most big Canadian banks or even Wealthsimple charge about 1.5% to 2% of foreign exchange spread. If you deposit 10,000 Canadian to buy SCHD, you lose around $150 to $200 on a day one. So that's the single fee wipes around nearly half of your first year dividend yield. So here's how experienced Canadian investor bypass that using Norbert Gambit method. So they buy shares of DLR.TO in Canadian dollars and then request to your brokerage to journal those shares into the US dollar side of your account as DLRU.TO and sell DLR USD and receive your US cash. So instead of paying 1.5%, you're paying a flat fee of I think $9 in Wealthsimple. Make sure your brokerage account allows dual currency subs account. That way when SCHD pays dividend in USD, the cash stays inside the USD and can be reinvested into share with zero conversion fees. One more question that I get a lot from Canadian viewers is that why not just buy a Canadian dividend ETF like VDY or XCI instead? So VDI is Vanguard Canadian High Dividend Yield ETF. So 70% is concentrated in Canadian banks and energy, whereas SCHD is Schwab US Dividend Equity. So it's well balanced across healthcare, tech, industrial, consumer staples, and energy. So VDY is a solid fund for eligible Canadian dividend tax credit in taxable account, but it's heavily skewed towards Canadian financial institutions and oil companies. So holding SCHD gives you the exposure to global consumer and healthcare giants that simply don't exist in TSX. So whether you're building long-term wealth inside an RRSP or using taxable account as a step toward early cash flow, SCHD offers a rare combination of strict quality screening, ultra-low fees, and compounding dividend growth. And I'd love to hear your strategy. Are you holding SCHD or do you prefer Canadian focused fund like VDY? Drop your thoughts and comment below. And if you enjoyed this video, hit the like button and subscribe to my YouTube channel. And I'll see you in the next video.